first one is liquidity, which is making sure we've got enough cash so we can meet any withdrawals that savers might want to make and to pay our bills. The second one is retail credit risk. That is that we lend to mortgage borrowers and not all of them pay it back. So it's obviously making sure that we can manage the lending so that with an expectation of it being repaid. We hold liquidity. We have to invest that liquidity into short-term assets. That's a thing called wholesale credit risk. Again, making sure that we invest that wisely so we do get our money back. The fourth one is interest rate risk. Sometimes we might borrow on a different interest rate basis to what we lend on. For example, we might borrow at a variable rate and lend at a fixed rate. And we've got to, if there was a change in interest rate conditions, we've got to make sure that that risk is managed. Another risk is operational risk, and that is a risk that a process or something we do fails, or an external event happens that damages the society. For example, if there was a major flood. Finally, there's conduct risk, and that is the risk that we do something that isn't in the best interest of our members.
The mortgage market review is something in the first quarter of 2014 which we are very much on board to deal with and to respond to the regulator.
Well, probably the biggest one that we're working through at the moment is the change to our IT systems. It's been a big issue for us in the last 12 months as we've sought to move our mainframe systems across to a new system. It's been very important to manage that through, and in particular to make sure that service to customers doesn't suffer in any way.